Hey there, everyone. You are watching Insight. You guys know that we've got to be able to take some time to check in with Foster Financial's Heather Foster, always bringing us those important financial tips. Heather, it's a pleasure to have you here.
It's always good to be here, Tony.
Always good to have you here. All right, today we're talking about NUA strategies. What exactly is NUA?
NUA is a net unrealized appreciation on an asset, aka a company's stock. So this is a strategy that we implement when we do our financial planning sessions. One of the things we verify is when people come in, does your company plan have any company stock within the actual employer plan?
Right.
Because there's a one-time and basically only one-time opportunity to take that stock. So don't sell the stock, first of all. Don't make any changes in the plan. If you've got company stock you've been holding on to, don't do anything until you talk to somebody.
Yeah.
Because you only have this as a one-time opportunity. So let's say you bought the stock at $10 a share, and now it's worth $20 a share. You have the ability, if there's appreciation, right? So we went from 10 to 20, appreciated,
right,
to pay taxes on as ordinary income on the basis of what you paid for it. But you can take the entire gain and roll it over to a non-qualified account where you'll pay capital gains. So again, let me just give you an example. Somebody who's in the 22% tax bracket. If you roll the entire thing over, when you separate from service, you retire, whatever it may be, you're going to move it to an IRA. And if you're in the 22% tax bracket, money out of an IRA, you pay 22%.
Right.
So all of the money becomes taxed at 22% or whatever tax bracket you're in. However, if it was done as an NUA, you would only pay ordinary income tax on the basis of what you paid for the stock, but the gain gets to be rolled over and taxed as a capital gain, which is taxed at 15%.
Okay.
So do you want to pay 22? Or do you want to pay 15?
15.
Right. And then if you happen to be lucky enough to be in the 12% tax bracket, would you rather pay 12 as ordinary income tax or 0 on the capital gain? 12 or 0?
Probably 0.
Probably 0, right?
Yeah.
So it's a one-time opportunity, and we strategize heavily to actually purposely keep somebody in the 12% tax bracket for a certain number of years so we can get that capital gain tax at a 0 rate.
Right.
And it saves them a ton in taxes. So the concept, again, is don't just, one, sell your company stock in your employer plan. Get advice before you do it. 2, don't roll over your 401k to an IRA. The first thing that people do when they retire or separate is say, hey, I need to roll my 401k over. If you roll it over to an IRA, you miss the opportunity. This has to be done in conjunction with the rollout, so you can roll the stocks separately, and then you can roll the rest of your employer plan to an IRA or a Roth IRA, depending on the type of money that is in the employer plan. But you have to do it all in the same year, and there are rules and regulations with it. So if you miss it, you miss it. It's a one-time, one shot. If you don't do it right and the way that you have to do it per the IRS's guidelines, you'll miss that opportunity. We've had cases where we've avoided capital gains and ordinary income on hundreds of thousands of dollars because we strategized. We did the NUA, we kept them in a 12% tax bracket, and then we slowly sold off the stock as a capital gain, but because their income was in the 12% tax bracket, they paid no federal tax on it. So strategy is key if you're not working with a financial firm that is handling your retirement like they're your CFO, where they're not just doing the investment management, but they're doing tax strategizing, health insurance strategizing, Social Security strategizing on an ongoing and regular basis. That's where someone like us comes into the picture.
Yeah, like you said, ask those questions because you don't want to miss out on this money that you could possibly be saving.
Yeah, we see it all the time. People roll their 401k. They didn't know that this strategy even existed. No one looked into it prior to them doing the rollover, and they've missed the opportunity.
Yeah, we don't want to miss out and leave money on the table. Never leave money on the table,
hey,
right?
Money is money.
Yeah.
Less money to the government means a higher rate of return on your own investments, and that's how we look at taxes.
All right, and if anyone has any questions, all they have to do is give you guys a call, get that complimentary consultation in, right?
We do a 15-minute quick prospect intake call where we just ask you some questions, figure out where you're at in your walk in retirement, and then we kind of go from there.
All right. Thanks so much, Heather, for everything. Appreciate
Always good to be here.
All right. You guys take a look at your screen right now, and you can find out more information about that complimentary consultation. Go ahead and give them a call. Visit that website. We'll be right back.